Stocks versus bonds. What's the difference? If someone gives you money and says, "Help me invest it," and your options are stocks or bonds, how do you know which one makes sense? Are stocks just gambling? Are bonds only for rich people? And which one is actually safer? In this video, I'll explain stocks versus bonds using everyday examples. So by the end, you'll understand how they work, the risks, and who each one is best for. Let's break it down. Let's start with stocks. When you buy a stock, you are buying a small piece of a company. Simple. Imagine a company is like a big supermarket. If the owner divides the business into 1,000 pieces and sells some of them, each piece is a stock or share. So if you buy shares in a company like MTN or Dangote Cement, you are now a part owner of that business. What does that mean? If the company makes profit, your stock can increase in value. If it grows bigger, your investment can grow. If it performs badly, your stock can lose value. Stocks have higher potential returns, but they also come with higher risk. Now let's talk about bonds. Bonds are very different. When you buy a bond, you are not buying ownership. Instead, you are lending money. Think of bonds like this. You give money to the government or a company, and they promise to pay you interest regularly and return your original money after a fixed time. So bonds are basically an IOU document. In Nigeria, common examples include federal government bonds, treasury bills, and corporate bonds. Bonds are generally more stable, but the returns are usually lower than stocks. The February 2026 federal government bond was opened for 1 week, February 2nd to 6th, with options for a 2-year or 3-year tenor. This bond allows you to start with as low as 5,000 naira. Make sure you stay connected with our social media so you don't miss out on important updates. Now let's compare them clearly. Stocks versus bonds. Stocks. You own part of a company. Bonds. You lend money. Stocks. Higher risk. Bonds. Lower risk. Stocks. Higher potential reward. Bonds. Lower but predictable returns. Stocks. Prices move up and down daily. Bonds. More stable income. Think of it like this. Stocks equal growth. Bonds equal stability. So, which one is better for you? Here's the truth nobody tells you. Stocks and bonds are not enemies. They actually work better together. If you're young, willing to take risk, and investing for the long term, stocks may make more sense. If you want steady income, don't like risk, and need predictable returns, bonds may be better. Most smart investors combine both to balance risk and reward. So here's the summary. Stocks mean ownership. Bonds mean lending. Stocks grow faster, but are riskier. Bonds are safer, but grow slower. The key is not choosing one forever, but understanding when and why to use each. If this video helped you understand investing better, like, subscribe, and share it with someone who thinks investment is only for rich people. See you in the next one.